Securing $5 to $50 million in life insurance coverage without liquidating your performing assets requires a highly sophisticated structure. By pledging existing assets as collateral, you borrow from a third-party lender to fund the premiums, keeping your capital deployed where it earns a higher return. Many high-net-worth clients look at that math and assume the strategy's success is guaranteed once the decision to finance is made. Choosing to finance triggers a second, more consequential decision: the specific methodology used to construct the arrangement. Selecting that green path forces a choice between two radically different advisory models. You can engage a captive advisor, or you can work with an independent broker. A captive or single-source advisor operates within strict boundaries. Engaging them locks you into the one or two lenders they default to, and a small handful of insurance carriers. The resulting arrangement is built to fit the limitations of the advisor's contracts, rather than the specific financial reality of your estate. An independent market aggregator, like Diversified insurance brokers, takes the opposite approach. They shop the full spectrum of carriers and lenders simultaneously to custom-build the structure around your exact credit profile and coverage requirements. In premium financing, market access directly dictates risk mitigation. The depth of your broker's Rolodex serves as the primary defense against unfavorable terms. The differences between models become clear when examining the four core pillars of premium financing. The first pillar is lender access. Default advisors typically bring one or two options. Independent brokers bring the case to 6 or more primary lending institutions. That access creates leverage. By placing multiple lenders in direct competition, the broker can simultaneously negotiate the loan covenants, the specific collateral requirements, and the interest rate spreads. Premium financing loans use a floating interest rate, typically priced at the Secured Overnight Financing Rate, or SOFR, plus a lender spread. If your advisor only has one lender to call, you lack the leverage needed to compress that spread, leaving you exposed to uncompetitive floating rates. Independent brokers use competing term sheets to drive those SOFR spreads down. They pit the lending institutions against each other to secure the lowest possible borrowing cost for your specific tier of creditworthiness. This efficiency requires a trade-off. Forcing multiple lenders to compete for your debt requires a highly rigorous, comprehensive upfront credit underwriting process. Accepting that upfront scrutiny protects the long-term health of the plan. Over a 20-year arrangement, driving down a lender spread by even 0.5% eliminates hundreds of thousands of dollars in excess interest costs. The second pillar focuses on policy performance, determined by carrier access. Single-source advisors, incentivized by volume quotas, recommend policies their parent company requires. Independent brokers test the entire market of over 100 carriers, matching your specific profile to the policy projecting the strongest growth. Policy performance dictates the safety of the entire arrangement. The policy's cash value serves as the primary collateral for your loan. If an ill-fitting policy underperforms its illustrated projections during years 8 through 15, the cash value will fail to cover the rising loan balance. When that gap opens, the lender issues a collateral call. You will be contractually obligated to immediately pledge additional liquid assets from your outside portfolio to keep the loan from defaulting. Avoiding that scenario requires a heavy upfront time investment. You and your wealth team will need to cross-examine a wide array of initial policy illustrations to confirm the math holds up under stress. Running a carrier-agnostic selection process is the only mathematical method to secure a policy robust enough to prevent catastrophic margin calls down the line. The third pillar covers advisory coordination. Independent brokers actively manage multiple parallel tracks from day one. They coordinate medical exams for the carrier, credit underwriting for the lender, and structural planning with your attorney, so all three intersect at implementation. Running these tracks concurrently exposes structural flaws early. It allows the team to identify gift tax liabilities and conflicts within your existing trust documents long before any contracts are signed or premiums are paid. This level of coordination requires heavy initial engagement. Your existing legal and wealth management teams must dedicate time to integrate with the broker's process. The final row of our matrix addresses the most critical phase of the timeline: ongoing management and the exit strategy. Poorly designed plans often defer the loan repayment entirely, assuming the eventual death benefit will clear the debt. If interest rates spike and compound over several decades, the loan balance can eclipse the death benefit, leaving the policy completely underwater. The independent protocol enforces a documented mathematical exit strategy. They establish clear options to repay the loan using cash value or planned asset dispositions at specific intervals, typically at policy years 10, 15, and 20. This requires mandatory annual reviews. Every year, the current loan balance, interest rate trajectory, and policy performance are mapped against the original projections to ensure the exit window remains viable. The entire financial architecture must be engineered to absorb unexpected market pressure and interest rate volatility without snapping. Premium financing is never a set-and-forget transaction. It requires active, ongoing advisory management and proactive stress testing to guarantee the loan is retired efficiently, without relying on the death of the insured to fix the math. With the structural mechanics clear, we have to evaluate who actually qualifies for and benefits from this intense level of financial architecture. The ideal candidates hold a net worth above $5 million. They are business owners, real estate investors, and executives whose wealth is heavily concentrated in complex, illiquid assets that generate high returns. If you are simply looking for a zero-maintenance way to avoid paying premiums, or if you are unwilling to undergo rigorous financial scrutiny, you should explicitly avoid premium financing. The ongoing management will outweigh the benefits. For the ideal candidate, successfully executing this strategy comes down to a single prerequisite: properly vetting the broker before the engagement begins. This checklist outlines the baseline standard you must demand from any advisor offering to build a premium financing arrangement. First, verify their market access. They must prove they hold active relationships with a minimum of 5 primary lenders and maintain appointments with at least 50 insurance carriers. Second, require procedural discipline. They must utilize in-house underwriting to manage the parallel tracks, and they must deliver a mathematically stress-tested exit strategy before you authorize the first premium payment. When tens of millions of dollars in collateral and estate liquidity are on the line, independent market access provides the structural defense your legacy requires.